Okay, my name is Christopher Terry, CEO of iMarkets Live. It's 10:33 a.m. Eastern on October 21st. We're just going to do a little class here on market geometry and how I like to use Fibonacci. I like to use swings and how we put it all together. So we're just going to draw it out conceptually at first, so we're all on the same page here. So just give me a moment. All right. So if we take a look at the trend, okay, the trend goes from low to high, the primary trend. And we always look at what the primary trend is. All right, so let's just make this thick. Okay, we'll make this up, blue. So always looking at where the primary trend is. The primary trend would be up. Now let me just fix this a little bit more so it's a little bit more organized. It doesn't matter the price, it doesn't matter with the chart. We're just looking at the higher time frame. So this could be an hourly chart, it could be a daily chart, it's irrelevant. And for the market to go from point A to point B, there has to be some type of a structure. And we look at what's called the Dow theory, and basically the Dow theory says that the market will go from low to high, and then it's going to retrace 1/3 to 2/3 of its rally, or if it's a downtrend, it'll come up and it will continue. And the market has the tide. This is the tide, and then you got the wave, which is in that, and then you have the ripple. Okay, you have to look at the market like an ocean. So if we were to take all three of these and combine them, they look like this. You have the tide, you have the wave, and then you have the wave, and then within it you have the ripple, and that's the way the market basically works. This is old school technical analysis. And there's a theory, it's called the Dow theory. You could search it out, and it gives you some information on that. Okay, but I'll break it down and make it easier. So Elliott came in after this Dow theory, came in from a book, Stock Trends of Technical Analysis of Stock Trends from Robert Edwards, Edwards and McGee. I forgot the McGee's first name, John McGee. Robert Edwards and John McGee, Stock Trends, Technical Analysis of Stock Trends, and the Dow theory was in there. There was a book prior to that, was called it's what they consider the Bible of Technical Analysis, from a guy named Schabacher. So these are two of the books that really are the foundation of technical analysis. Elliott came in and took Dow's theory and put structure to it. And he had his own structure. He has all sorts of wave theories, but he put structure around it. Similar to if you just to take a square football field and put in the 50-yard line and the 30-yard line and the 20, and you put the ratios, their structure. So if we look at the primary trend being up, what we're going to do is do this. We're going to take this swing right here. Well, we're going to do this. Okay. Just for purposes. Okay. And then up. Forget about all this other stuff there. I just want to focus on this. So we're looking at this as the primary trend. So I'm going to make this bigger, thicker. We're going to call it blue. All right. So this right here is the primary trend. Within the primary trend, we have to understand that the market has what's called these intermediate trends. Okay. So the intermediate trend would be this. So market would rally, would pull back, would rally again, pull back, and rally again. So let me just organize everything so it looks better, okay? And I'll change the colors. I'm just trying to get everything formatted. So we are going to consider this uh, more or less the intermediate trend right there. And we're going to call this red, okay? So now you have the primary trend, you have the intermediate trend, and then you have the minor trend. The minor trend basically is this. And just allow me to fix this, okay? Okay. Let me just clone this. I give a good representation what we got here. And let's just clone this again one last time. Okay, and we'll get everything organized. Okay. Okay, so when we're looking at the markets, we have to look at them in terms of where the markets end, where the cycles end, and where they start. So market has quote unquote a double bottom or a shift up, and we're looking at what the bigger trend is. We're looking at a daily chart. The red would be in the hourly chart. The black would be the 15-minute chart. So to go from 0 to 1, and on on the primary, the intermediate would be 0 to 1, and the minor would be 0 to 1. You see that? We always have to look at things in waves. We have to understand where we are within the structure of the overall market. We're not just going to come in and become bullish right here. That would be foolish. Okay, that would be extremely foolish. If we look at what had happened with the NZD USD, we saw that last move up. There was a large trend down. Market retraced itself all the way up and then turned down as we started shorting. So let me just, for purposes here, let me see if I can bring up, and let's see if I can unconnect these charts here. All right, I may mess this up a little bit, uh, but I just want you to guys NZD USD. I may mess the charts up a little bit. That's okay, but I want you to see the representation of the actual chart. So we have a big move down, and we're looking at this big correction. This would be equivalent of, say, a primary trend. This is the primary trend, right? But for argument's sake, this right here being a primary trend, a correction, we're going to have those intermediate and minor cycles within it. All right. This also primary trend and continuation. But let's go back to that other chart just so you see what we're looking at. Uh-oh, hope I didn't screw it up. Oh no. There we go. Get over here. Okay. Okay. So you're looking at the primary trend. It could be that big correction that we just saw in the NASDAQ, NZD USD. Even that big retracement up. Same thing. Primary trend is expected to go from low to high, and the only way to get there is we're going to have to break it down into sections. So we know that the market's going to have to go all the way up here for, say, a correction, or just like we saw the NZD USD. The market needed to go up. And the first thing we want to see is a shift in momentum from down to up. And we want to see the market shift hard and then put that higher low in. But within that, we want to see the shorter term shift from low to high, put that higher low. Trends start on the lowest time frame. They always start on the lowest time frame. There's no question about it. And although we're looking at the higher time frame correction, we start looking at the smallest time frame for trend entries. So if we're expecting it to go up and we see a shift from low to high, even on the smallest time frame, so you got daily, hourly, 15 minute. 15 minute runs up and puts a higher low. We're looking at the first swing, first retracement within the larger picture. So we tend to see, and I want you guys to get understanding this, you have the tide, the wave, and the ripple. So within that first move up, you may have an hourly move up, but the 15-minute chart has to make its waves, has to correct itself up. And sometimes it doesn't do it like that. Sometimes you may just get something like this. Sometimes off the low, you may get this, that. You just may get some funky little action. And it's just a matter of time before it starts to unveil itself what you're expecting. So we look at harmonics, we look at all sorts of things. So if we look at harmonics and Elliott within the same context, the reason I like to look at harmonics in terms of a bullish structure is because it just makes sense. So if we look at harmonics where the market does something like this, okay, guys, you can start to see where it just makes sense. Okay, you're always looking at all these little harmonics. Sometimes they're not so pretty, but essentially that's what we see. We look at here, all right, here. Okay, we may even see something like this, okay? And we see these retracements. It may have to come from another swing low, but whatever the fact is, that's we look at harmonics in that regard in the bullish structure because we're looking at retracements within the primary trend, within the intermediate trend, and they can even start on the smallest time frame. We can have them even on the smallest time frame where we have like little structures down here. I should erase that because it's just so small. But when we're looking at market geometry, a lot goes into this. You know, Elliott wave people don't look at harmonics. Harmonics people don't look at Elliott wave. and vice versa. It just they don't do it. I don't know why. I see all these books, they just all shy away from each other. What I like to do also is I like to look at areas where the market can retrace, and what I end up doing is I end up picking a higher low. Okay, and let me just put all my retracements and show you. So I would lay it out something like this, where I would take, you're taking the lowest low to the highest high. And when you're looking at retracement structure, okay, when you're looking at retracement structure, you have to say how deep can this come? And what I end up doing is I take all these higher lows, all of them. I take all these higher lows. All right, and obviously this is not a real market because I drew it out, but I look at all these little swings and I look for other spots and I start doing this. And I'm looking where the market may have a cluster. Okay, just a natural cluster of information. Okay, natural cluster of information where the market will now have a certain retracement, maybe a 618 from here, or whatever that is, and from here it's a 50%. From here it's or 86%. From here it's an extension down, and all I'm doing is I'm looking at market structure. The same thing we had up there is you get this from here. When the market has to go down a lot, you start getting these waves. Okay, same thing. Okay, let me just draw this out. Oops, I did something wrong. Hold on a second. I didn't mean to do that, so we'll fix that. Let me just do that again. So market comes down in its own wave structure. For example, let's just move this here, make everything pretty. So when we look at waves, you have the primary trend, you have the intermediate, you have the minor. Let me get rid of the harmonics. We're not needing this at the moment. Okay, so when the markets form these patterns, you may get a big retracement like this, or you may get something like this. It all depends how they come off the high. You may get something where the market wants to do a corrective wave, and I'll show you what we mean. So now you had a big primary trend up. Now the market has to come all the way down. That's why a lot of times we talk about that lower high down. So because the market had a big primary trend move up, we're looking for a retracement down. A lot of times it goes after the fifth wave of the fifth wave. What do I mean? Watch. 1, 2, 3, 4, 5. But that's the first. Then it's 1, 2, 3, 4, 5. That's the second, right? Fifth. That's fifth wave of the fifth wave, right? Then you got a 2 to 3, and then you go 1, 2, 3, 4, 5. And what's happening, this is the first leg of the primary, well, this is the primary trend. First leg of the primary trend. You have the second swing, with actually third swing. I'm sorry, first leg of the primary trend, and then you had the fifth wave of the intermediate, and then the fifth wave of the minor. So everything comes into this junction. You're now getting your ABC down, and a lot of times these ABC corrective waves, which we expect, those are also broken into smaller 5 waves, or we also have ABC. For instance, you may get this. here, here, here. Okay, you're either going to get one of those, and then you're going to get uh, from that, you're then going to get, let me just shorten, let me shorten. Then you're going to get 1, 2, 3, 4, and just have to forgive my drawing. So a lot of times you're going to get that, and then you're going to get this. Here, here, here. In between these little swings here, 3 to 4, 3 to 4, most of the time you're getting these little ABC corrective waves. See that? Little ABC corrective waves within these structures. Each of these should have those. That's where a lot of times you see these little, also these harmonics will come from here, 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 and you get those like little gartleys or butterflies that come in right there. So everything has structure. You have to know what part of the structure you're in. So when you look at the chart, you look at a higher time frame, you have to determine where the trend is. What part of the wave is it in? You know, are you still in the primary trend up? And is the market right here? You know, what are you waiting for? What's the next swing? So what we like to do is we like to look at turning points and completions of waves before we do anything. And that's why we tend to get very, very good moves off the market because of that purpose. We're always looking at where in the market structure are we. And I'm taking all these little highs and lows and I'm using them as retracements so they line up. So if you think about it, we're putting retracements from the low, from the higher low, from the higher low, from all these little lows, from this swing low. We may do something from here looking down, which is called an extension. We may look at all sorts of little things like that. If we look at this in terms of harmonics, you may have something where, all right, just because it looks pretty doesn't mean it's important. We're looking at what all these little swings here, retracement values, how they line up. We're looking at what part of the wave we're in. Does it need to go further? You know, is it a fourth to fifth? Is it an A to B? So we look, or A to B, or we're looking at a B or C D extension. We're looking at all of this before we look at a trade. We have to. The average guy doesn't see this. They don't know what they're looking at. I mean, this is something this is whole next level market geometry stuff. But this is what we do. This is what we actually do when we're looking at stuff in the room, except that a lot of times I can't really take the time to do that. And I will as we go forward. You know, just have to please just bear with me. I got so much going on when I'm sitting in front of the computer. My whole focus goes into a different energy. But at least, you know, we have the time to learn, where everybody else right now is still looking at the markets trying to figure them out. You know, how they're going to make money. We already made our money. We made it in 5 minutes this morning. We're done. You made your paycheck. Now it's time to feed the brain. So if you can really just take this video and watch it over and over again, you'll understand that you need to be identifying what part of the wave you're in, what part of the trend you're in. You know, what if you're right here? What if you're right here? Where are you putting your risk? What if you're right here? Why would you enter? What would be your target? If you're entering here, you know your next swing is only so big. A lot of times guys get in here, and I'm sure this has happened. You buy it here, it goes up a little bit, comes all the way down, stops you out, and then goes, and you're like, I knew it. I had the right trade, because you didn't identify where in the trend you are. So, for instance, like sometimes I'll say, buy it here and put your stops here. Well, the reason I'm doing that is because you are looking at a particular part of the wave that even if it comes down, it should not come back below a certain point. So that's what we do. All right? A lot of times I'm doing that. You know, I like to spread the love over a period of time also, because I know how people are. They want to come in, they want to learn everything right away today. They want to take off and they want to become the teacher. And in fact, they're not. So you have a lot of these high school gurus that are in the markets for a couple of months or a year and they're selling courses and they're blowing people up. So I've never blown people up. I've always taken great care with that and make sure you're always on the right side. So my job is to educate you, educate you, educate you so you understand what you are. When you're looking at the market, you understand the trend. You understand, is it an uptrend? Is it a downtrend? Is it a minor trend? Intermediate? Are you within the primary? And then when you start looking at harmonics, you start identifying things in harmonics that most people can't because you already know the truth. You know the game. Is it maybe a butterfly pattern? See the butterfly pattern? Most people, and including, I'm not going to get into names, most people, including some of these quote unquote pioneers, don't understand this stuff. This is what we do. We understand it. We don't really need these harmonic patterns to tell us what we know already. But they're pretty, you know? They're pretty. Entry techniques. Entry techniques are always important. Okay? Entry techniques are always important. Let's get rid of this. Come on, get off my chart. Okay, entry techniques are really important. Let's just say that's your entry zone. Okay, let's just do this. Okay, that's your risk point. This is your entry. All right. Okay, so I like to do is I like to identify where in the trend we are. So a couple of ways to look at it. Let's take this Elliott wave. All right. Market's doing its wave, doing its wave, doing its wave, and then pushes down. Okay. Okay, we're getting our push down into the zone. We got that. Two ways to look at it. Number one, what if the market hits here and stops? Okay, what if the market hits there and stops? Well, our job to do is let that market shift. We want that market to shift up, even out of the zone. Put that higher low. Shift it. Okay. Okay, that's typically what we like to see. Okay, so here's how I like to look at even using the harmonic scanner. I want to know that this wave right here, this is completing, that the market retraced into the zone. Once it's done that, I want to see the shift in momentum up and then at higher low before I take a trade. A lot of times you get this. Okay, you'll get this. All right. And there's another trick. Markets in a higher time frame, you get that shift in momentum and then you get that pullback. I don't know why this is not the same, but well, whatever. Anyway, market shifted down and now you got this shift right here. What's important is when you see this swing down, but the swing up is greater than the swing down. When you get that, then that higher low. So when you get that shift in momentum from down to up, this right here is greater than the prior swing down. That's shifting the momentum from down to up and saying that I'm not going down anymore, that I need to start going up. When you start to get that, then you're getting your retracements into the on a pullback. You want to buy them. Your risk is always down here. Okay, risk is right below the low. You don't want to go there again. This is the suggested risk point. How I look at this in harmonics, this is my suggested risk point, period. All right, so example. Okay, whatever it is. Here's your entry, right? Okay, this is your risk point. That's suggested. That's not. It doesn't have to be definite. It's a good thing to have that type of structure. Some people like that. I am more of, I want to see, and let's just do this, okay? Let's just pretend. Okay, makes sense now? You got your 5 wave within this arm, this leg down, and you find the swing. Market bounces, gives you a nice retracement, you enter. Okay, that's a real good way to look at it. All right, but what if? What if it goes past your risk point? Okay, let's just get rid of all this other stuff here. Let me just. What if you have a situation where even on your harmonic scanner, oh my God. All right. What if this flushes down like that? Okay. What if you have that? What if this pattern was there just like that and this leg flushed down? You're still waiting. You're still watching. You're still waiting. You're still watching. All right. If this is a legitimate pullback within the context of an uptrend and you're getting this, and this goes deeper than it should, just because it broke here doesn't necessarily mean that it's failed everything. Sometimes you'll get that excess to the downside where the market then shifts back up. And we've seen this a lot. And then the market does this. And you're saying to yourself, I had this. I knew it. No, you know what? You flush down deeper. It hit that risk point. You didn't get in because you want to make sure that prices stop. They want to stop going down. You want to see the shift in momentum. Even if they go past the suggested risk point and shoot back up, you still should look at that. That first retracement down, you want to start looking. So the fact is, if you're thinking about it, this may be a 15-minute chart. This shift, or hourly, this shift in momentum starts the process for a whole nother leg to the upside. Okay, a whole nother leg to the upside. And all you're doing is getting that first, that minor within the intermediate, or you're getting that intermediate within the primary. Essentially, what we talked about here. Okay? Essentially, what we talked about there. Same condition. Okay? Same condition. Market stops going down. You get the bounce. Okay? You, as long as you're identifying where in the trend you are, the pretty pictures are great, but you identify where you are in the trend. And when you understand that, the harmonic patterns become more powerful. Your analysis of the trend becomes more powerful. You could throw in all these little fancy indicators. It means nothing. All right. Whatever you need to do to make yourself happy, fine. If you want to put indicators there, that's great. I put a lot of times, I put Bollinger Bands. If the Bollinger Bands exceed a certain point, they tie into the zones. But this is how I actually look at the charts. Okay? So I just wanted to do a little class, get you guys updated on some things. And this class is going to go in the harmonic trading course class section. All right, so you guys will hear live, and I'll get you. Actually, I'll put this up on both sides, on the regular side and also on the course. All right. So anyway, my name is Christopher Terry, CEO of iMarkets Live, and I just wanted to give you an update on how to read the market using market geometry, tying in Elliott wave, tying in wave theory, tying in retracements, tying in harmonics, entry techniques, risk techniques, all within a short period of time. Have a great one.